switch around our schedule a little bit because of technical difficulties, but there's no reason why we shouldn't continue on with the webinar. So we'll just flip around a little bit of schedule. Gregory McLeod will be on after me, and so we'll just do it. So what we're going to do is we're going to talk about high probability breakout trading here. And well, basically what we want to do here is kind of pick up where we left off just previously, and talk specifically about the the trade setups and how to take advantage of them, but really more importantly how to identify them in the markets. And we're really going to talk about trends here, and they're going to be a lot stronger than we had previously. And of course, as usual, we're going to start off with our risk disclaimer. Trading foreign exchange on margin, and it really is that margin that gives you that leverage that really can make or break a trader. We want to use that as a tool and be aware that it can result in some incredible gains, but more importantly, it can really result in some incredible losses, and that's really what we want to be aware of, and we want to be in tune to that and make sure that we don't get caught up into seeing all the potential of all the dollars that we can make and just risk everything and end up losing it, because it really does happen a lot more than maybe you realize. If you've been in the business for a long time, you see it, unfortunately, time and time again. So the first thing we want to do is identify the trend, and because, as I just mentioned before in the previous webinar, this is really where it all starts. We want to identify a market that is really where either the buyers are in total control or the sellers are in total control. We want to be where the money is. We want to be where the momentum is. And like I'd mentioned yesterday, my idea of trading is finding a train that's moving quickly, hopping on board and hanging on for as long as you can. And that's basically what trend trading is. And I want to tell you that if you talk to professional traders, you will find that most of them, particularly off the floor traders, which just there are very few on the floor traders anymore, and those traders have had to change their style of trading to basically trend trading, and just identifying those strong trending markets and just taking advantage of them. And so buying new highs and selling new lows, it can be a little bit scary, but at the same time we've got to move past that and realize that that is what more traders do to become profitable. There are more profitable traders who buy new highs, assuming that the market's going to continue to move up because there's a reason it's gotten to a new high, rather than say, well, this market's at a new high, it has to turn around and come back down, I'm going to sell here. As soon as you start thinking like that, you are just basically feeding those traders who are trading with the direction of the trend. Because remember, this is a zero-sum game. With every dollar lost, there's a dollar won. So when you hear other traders talk about picking tops and bottoms, pat them on the back and say, we need people like you. What do you really mean? We need your money in there so the traders who trade in the direction of the trend, have somebody to take the other side of their trade. Okay? They can trade whatever way they want, but I really want to impress upon all of you that identifying a trend, even if it's a 1-minute trend, but identifying the momentum of the market and finding those markets that are moving strongly and jumping on board and just taking advantage of that movement. So an uptrend is simply a market that is making a series of higher highs and higher lows. It looks like a stair-step formation. We saw some examples in our previous webinar, and we'll be looking at some more examples here down the road. Now, an uptrend changes to a downtrend when the market trades down through the previous low. Okay. Now, when this happens, it doesn't necessarily mean that we're automatically going to be looking for selling opportunities, because remember, we're looking for the strongest trend. We've got more than 60 different investment vehicles that we can take advantage of with Aura FX. Use that to your advantage. Find those markets that are trending strongly. I always like to tell the story that at one point in time, before computers, and yes, we have been in the markets that long, so everybody had a computer on their desk, but we used to get from Mansfield Charts, would mail you the charts of all the stocks, the S&P 500 or whatever you subscribe to. I used to get the S&P 500, and you would get it on Saturday, after Friday's close, and it would be, to show you the chart for the week. And at the end of the week, over the weekend, I would put them in 3 piles. One pile are strong uptrends, one pile are strong downtrends, and by far the biggest pile was in the middle, markets that I really couldn't tell what the trend was. There was no trend, or it was just herky-jerky. Just not easy to identify what was going on in that market. And my son, who was about 10 at the time, asked me if he could play. I remember those were his exact words. And I said, sure, and I explained to him what I was doing. And then he started, doing what I was doing. And he was making some really good choices. And I thought, wow, I've got a prodigy here. But then it really kind of dawned on me, no, Tom, before you get into this where you're a genius and you're brilliant, we're just keeping it simple. We're making it obvious. And I told him to only pick the ones that you were sure about, and he was picking them. The moral of the story is, don't overthink it. If you can't tell immediately the direction of the trend, then that is your analytical side telling you, don't trade this, move on to somewhere else. So we have a downtrend as a series of lower highs and lower lows. We can see the stair-step formation moving down, just the opposite of a strong uptrend. Now a downtrend changes to an uptrend when the market trades up through the previous high. And again, that doesn't necessarily mean we're going to jump on board on the buy side, because at this point in time we can look to other currency pairs or CFDs, whatever it is that we want to choose to trade, and we can find stronger trends that are more mature, that are very, very obvious, that are still going on strong and still are offering some solid trading opportunities. Now, this is what we talked a little bit about this before in our previous webinar, where it's the ABC move. Now, calling it an ABC move has been around for generations. Well before Elliott wave theory became popular in the 60s. Even though Elliott wave was around back in the 20s, it really didn't become popular until the 60s. But the ABC or 1, 2, 3, or whatever people wanted to call it, those kind of moves or chart formations have been around that long. And basically we've got the move from A to B, which is the trending move, and that move from B to C, which is that counter trend move. Now the breakout is we're going to buy as the market moves up above point B, thereby confirming that the trend is intact and that C is our low point. So if we're buying here on a breakout above point B, we're placing our protective stop below point C. That is giving us our risk. It is very clear, it is obvious, and it is consistent, and it is using support and resistance as protection for that stop, which really is the best way to identify a stop, not just by some random number, depending on what your account balance is, by what you see on the chart and where the markets have reversed before. If the market moves back down there, is it guaranteed to switch back to the upside? Now, you know what I say about guarantees. The answer is, of course, no. But it does offer some sort of support because there will be a certain number of traders who are willing to go down there and buy it as if it moves back down close to point C in anticipation of the trend remaining intact. Okay. Now we talked about in our previous webinar, if you're inclined to try to buy near point C, that is where technical indicators can help you better time that entry. But if you just want a breakout and wait for the market to confirm that it continues to move up, then we want to use a breakout style of trading, which I think you'll find probably more professional traders will use, just a simple breakout. They love buying high and selling higher, or selling low and buying lower. Okay, and they buy breakouts. That is, getting in on a stop is what that order is called. And you'll find that there are more professional traders who use stops for entry and exits than any other style. Okay, and of course, on the downside, when the market is moving in a downtrend and we're looking for selling opportunities, we've got that ABC move to the downside. As that market moves down through point B, this is where we sell. Now, of course, we've given all this up, but giving that up means that we're waiting for confirmation to show that the downtrend is still intact. And that's exactly what we're looking for. But it also gives us the point where we can place a protective stop up above point C. Our entry just below point B. Now, when I say just below, I just mean 1 or 2 pips. No sense in getting crazy. And we place it above point C. Again, just 1 or 2 pips. No sense in being crazy. If it's going to move through, 1 or 2 pips higher, then that means that there are no more orders there as protection. Otherwise, what really causes support and resistance, if this market is moving down through point B, there are going to be some traders here who will buy just above point B in assumption that there's going to throw some support. If it trades 1 or 2 pips below point B, all of those orders are gone, okay, and there's really nothing left holding the market. And that's sometimes when you see the market move up through a previous high or low, it'll move slow, it'll move slow, it'll move slow, it'll go through, and then it'll run for about 10 or 15 pips. That is because all of the orders that have been sitting there trying to keep that market from moving through that previous high or low are now gone, and the only thing left are traders who have placed buy orders above that point or sell orders below to take advantage of that move. And as those orders are getting filled, you see a quick movement in that same direction. Okay, let's take a look at some charts and let's look at some examples here in the markets. I've got a few examples here. Now this is a daily chart of the euro dollar, and this has really been one of my favorites to show because of course once again I've got that 100-day simple moving average on here to help us identify the direction of the trend. Hey, any tool that I can use to simplify the process, I'm going to grasp on, and I'm going to hang on to dearly. And to me, the simple tool of the moving average, we spent some time talking about this in the last hour, but just to prove that I wasn't just making it up, I do use this tool just about in all my charts. But you can see the ABC moves, whatever you want to call the ABC moves. It's, the move down, then up, and down, and up. And this is the one I really want to talk about here because it, we're talking about the potential of the euro dollar moving forward. And you can see a nice strong A to B, and then the move from B to C, and then the market moved down through point B, and you can see that there are some traders there who are on the sell side, right below here. Okay, they were selling there, and we can see some more following, some more selling as we see the market following through as the weakness continues in the euro dollar. Now, this is for twofold. This is two reasons. Number one, the dollar has been showing strength. Okay. Number two, the euro has been showing weakness. So when you match up a real strong currency with a real weak currency, this is usually what you see, a strong trending market that we can take advantage of, hopefully time and time again. So this trade, using this approach is open right now, but that doesn't mean that this doesn't still offer value. And later on, we're going to be talking about multiple time frame analysis, and this is where something like this would really come in key, because even though that we may have missed that entry on the daily chart, that doesn't mean that we can't go down to a 4-hour or an hourly chart to kind of take a closer look at this, this trending move down and take advantage of the A, B, and C moves there. But more on that in a webinar later on here. Okay, now I want to move on to another daily chart, and we talked about this one using the MACD before, and this is just also not as strong as the euro dollar. Two examples I'm using this. Number one, you can see the ABC moves moving up, and just to show that that graphic I made just wasn't a pie in the sky dream of what the markets hopefully look like, you can see the market moved down through the previous high, thereby changing the uptrend to a downtrend, confirmed by a move below the 100 period or the 100-day simple moving average, and now we see the ABC moves moving to the downside. Now we see a little bit more strength in the British pound as we do in the euro. And of course, one of the reasons for this, of course, is the situation in Greece, where the British pound is in the eurozone, but they still maintain their own currency. And we're looking at it right here, the British pound. So it doesn't have that same weakness as the euro dollar. This would be a situation to where, it's pretty obvious, because if you're selling the breakout down through the low, this trade has already kicked off, where the pound dollar has not. But yet, at the same time, this is a strong downtrend, and at some point in time, if you're looking for the breakout, you would sell it below this high or this low, and use this as your risk. Now, I want to point out that that's about 500 pips, and some people will say, Tom, 500 pips is really big for a stop. It's way too much money for me. Well, 500 pips is kind of big for a stop. Maybe not so much on the British pound pairs on a daily chart, but it is, quite a big amount. But the actual risk in money to your account really is dependent not only on the number of pips between your entry and your stop, but also the position size. And that's where you can control how much actual risk to your account balance is the position size that you take. Obviously, if you're risking 100 pips, and you can take on a position that's much larger than if your initial protective stop is 500 pips, okay? Because again, You want to make sure that you're risking no more than 5% of your account balance at any one time. And or if you're opening up multiple positions, you can risk 1% of your account balance on the trade and open up to 5 trades at a time, because there's going to be a lot of trends that maybe you want to take advantage of. But that's just a matter of personal preference, and one way is not better than the other. I know some people like the idea of diversifying by having 5 trades open and risking 1%, and that's fine. If that's something you're comfortable with, you should embrace that because it's a solid way of trading. But there are others who just really want to focus on one trade at a time. They feel that they can concentrate and focus more. That's fine too. That's why there are choices. But either way, both traders are risking no more than 5% of their account balance at any one time, and that's really what they want to maintain in order to make sure that even though they experience losses, it doesn't knock them out of the game. You can get up, brush yourself off, and jump right back in. Okay, let's go down to a 15-minute chart. Of course, again, we saw this a minute ago, but this is a market that you can see the ABCs moving down, and you can see we've got a little bit of a, we're going to see a little bit of some counter trend moves here because of we have non-farm payroll coming out tomorrow morning. We've talked about this. Non-farm payroll is really the big daddy because I know you're probably thinking, what would New Zealand and the dollar and the Japanese yen have to do with the U.S. job situation? It doesn't matter. The fact is that it does. Every currency pair will jump around with incredible volatility based on the U.S. Department of Labor's non-farm payroll release the first Friday of each month at 8:30 a.m. Eastern Time. And so you want to be aware of that. Now what that means is that traders are now positioning themselves for that release tomorrow morning. And the counter trend moves that we may be seeing right now are going to be the U.S.-based traders who are, closing their positions or getting smaller. Get out or get smaller if you're uncertain. Or going to be getting smaller or getting out before the end of the day, so they don't have to do it first thing in the morning, because you don't know where the market's going to be trading in the morning. If they're comfortable with the price right now, then they're going to be exiting their trades right now. And if the trend has been down and they've been sellers, then of course to close that sell position, you do the opposite, you buy, and that will push the market back up. So we've got some short covering, which is probably what we're seeing in this currency pair, and or depending what else is on the calendar today. But that non-farm payroll is huge, and I keep mentioning that, but it is the night before, and I want you all to be aware of what's coming on. Now, for me, it's tomorrow morning. For you, it may be later on this evening. Now we have the euro pound, and this is a really good example of the relative weakness compared to the British pound. Speaking of the relative weakness of the euro compared to the British pound, we see a series of ABC moves to the downside, and we see some volatile jumps here. And this is an example. There is another set of releases on the calendar that I'm always aware of, and that is anytime a central bank has something to say. And we had maybe 3 this week, but I know that we had the European Central Bank, the ECB, and the Bank of England make some statements and have meetings. And whenever they release any kind of information, the markets will anticipate that, and a lot of traders will get out before and then get back in afterwards, which is one thing that I mentioned yesterday. Predicting what the news release is going to be is one thing. Predicting how the market reacts is totally different. Sometimes they're just not related at all. So we want to be aware of that. But yet they can wreak havoc. And as we get down in the time frame, we can see a lot more of these candlesticks, the wicks, because of the relative volatility on the shorter term charts compared to the longer term charts. One of the great things about the daily chart is that you can see how smooth these markets can trade. You see very little massive volatility. When you do, well, look at it. It was the first week. Right here, you can see that what was going on here. Well, it was the first week of the month, and that was the U.S. non-farm payroll, and you can see its effect on the markets. And as a matter of fact, here's another one right here. That was probably the first Friday in September, U.S. non-farm payroll. You can see what happens, with the market, and you can go time and time again. And I would almost say, well, 10-3. There you go again. You can see just by looking at a daily chart the effect of some of these news events will have it. but it's not as pronounced on the daily chart, or even on the 4-hour chart. On the 15-minute chart, it will just be dominated by a volatile move. So one thing when you keep in mind, depending on the time frame chart that you're trading, the volatility is going to be greater on the shorter term charts than the longer term charts, and that will affect our ABC patterns and potentially our trends, on a short term basis. One reason why trading on the daily chart and the 4-hour chart to begin with is an excellent idea, because you're not as susceptible to those. Even unannounced news events can wreak havoc on a solid trading opportunity. So you've got the euro pound, and then the last one we want to look at here is the euro kiwi. Again, an example of the weak euro. Now I've shown just 5 currency pairs here, and 3 of them have been euro, which is another key point. One of the advantages of trading the forex markets and to take advantage of these high probability breakouts is, as I go through all the currency pairs, and I just trade 28 different currency pairs. I trade the pairs that include the euro, the pound, the Swiss, the CAD, the Aussie, the Kiwi, and the US dollar, and all combinations of those. There are 28 of them. I really shy away from some of the Nordic or some of the more obscure currencies, because I'm looking for charts that show plenty of liquidity. And between those 7, what I call the majors, but in the dictionary says they're not all majors, but I call them the majors. But there's more liquidity and more volume being traded in those, so they can more easily absorb any kind of volatility in the market, which means better trading. Okay, better trading opportunities and less of a chance of being stopped out on just a crazy move. And so, one thing to keep in mind, that when looking for markets to trade, is the more volume, the more liquidity, and liquidity means more volume. It's easier to get in and out at the price that you want, the better the trading opportunities are going to be. And that's why the euro dollar, is one of the best vehicles to trade on the face of the earth, because around the world there's more money being traded in the euro dollar than any other investment vehicle. And then after that, you'll probably find something like the US stock market indices and getting into some of the European stock indices. But the more the money that's being traded, the better the trading opportunities, in my opinion. And that is because of just the pure volume and the number of traders being involved. It just makes for cleaner looking charts. And if it's a cleaner looking chart, then these ABC patterns will show themselves a lot clearer than if it's a highly volatile market. But you can see even this most recent one here, from an A down to a B, and then we've got our point C, and then a sell down through this low. And we have the market following through to the downside. And so we're going to see how the markets react tomorrow morning. Keep in mind, and I know Greg McLeod, if he's out there, he's going to be talking about the, I will call it dancing around, because it's, he's going to be talking about trading around the news announcements. And it is definitely an art, because even if you're in a position, you want to be aware of that economic calendar. We used to get phone calls when we had days of big volatility, phone calls from clients who would say, what in the heck happened to the market? Well, we would send them a link showing an economic calendar, because the only way to see these potential big moves is the economic calendar. They will show you the potential of the big moves. And I probably said it 5 times. Let's make it an even 6. Tomorrow morning. Now we're talking, we're U.S. based, but 8:30 a.m. Eastern is the release of the non-farm payroll. Okay, Greg McLeod, as you can see, has confirmed that he is here, so he is going to talk about dancing around these news announcements right up after we're done here in 25 minutes, so stick around for that. He's coming out the night before the big one. So now I want to talk about some of the keys that we want to talk about here with these ABC moves, and even what we had talked about previously with the use of technical indicators. Number 1, trade in the direction of the trend. I think that particularly new traders, I know how we just love to sit here and we look at indicators and we try to find ways to identify the perfect entry. I mean, that really is the goal, right? To find a way to identify trades that are only winners. I mean, I used to think that it was out there. It was out there, and I just didn't get it. And if I kept working at it, it was only a matter of time before I found it. Okay. Instead, what I found was that it doesn't exist. And instead, what I found is that professional traders really look at things a little bit differently. They look at the long term. Okay. They're not concerned about the next trade, whether it's a winning trade or a losing trade. Now, do they have their preferences? You better believe it. They would prefer to win all their trades too. It doesn't take any kind of an insight to understand that part. But I would think that new traders spending more time trying to identify strong trending moves to be able to take advantage of is a better use of your time than trying to find a way to find a perfect entry. Okay, an example. Some of us worked for one of the largest Forex firms in the world, and there used to be trading contests. And we'd have some traders come with some incredible returns for the month. I mean, I'm talking 1,000, 2,000%. Just unbelievable. And people would get all excited. Can you introduce me to this guy? I just want to have him manage my money. And of course, we didn't do that, but at the same time, a lot of those traders that made 1 or 2,000% would come to us in a month or two asking what the heck happened because they lost it all and more. Okay, well, usually what happened was the market was trading in a strong trending move during the month where they realized those incredible gains. If the market was just moving up for the whole 4-week period, and every time it came down about 25, 30 pips, they bought, and they were rewarded with that approach. They were rewarded. Why? Because they were trading in the direction of a strong trending market. The issue was they didn't realize it. They just thought that they had figured something out and it was going to last forever. Well, the market environment is one of the keys to the approach that you use. I know some traders who have 3 or 4 different approaches to trading the market. Which one do they use? They don't know until they look at the markets because it depends on the market environment. Is the market trading in a range-bound situation? There are some traders that enjoy that. I hate it. I stay away from that. I have no idea how traders can do that. It doesn't look fun, it looks slow, and I just don't get it anyway. Some traders use a particular approach when the market is trending up strongly to the upside. Some use a different approach when it's trending strongly to the downside. But many traders have more than one approach. Some traders, when the volatility dries up, will move down to short-term charts. They have a different approach that they'll use. Some traders, when the markets are really volatile, will take a step back and use the longer-term charts, and they have a different approach for using that. That is one of the keys to being consistently profitable in the markets. Understanding what it is that the market wants to do, because you cannot control the market. The market will control you, though. You better believe that's true. But being able to identify what the market is doing and taking advantage of it really has a lot to do with your success as a trader. It's got really nothing to do with finding a way to identify that perfect entry. Because I'm here to tell you, if that market is trending up strongly to the upside, you can use a million different approaches to identify where to buy, because all you're doing is jump, like I said before, identify the direction that train wants to move, jump on board, and hang on for as long as you can. Yeah, there is nothing brilliant about that. I mean, there is nothing mathematical. There is nothing new. That doesn't involve any kind of code. And that's one of the reasons why, maybe code has never been the thing that I've levitated to, that I've been interested in, because I think that I can eyeball the market and find those markets that are trending strongly, and then there are so many approaches that you can use, but you've got to have that directional bias, and in order to have that directional bias and be confident with it, spend some time to learn how to identify the trend of the market is going to be key to your success. And it might be one of the best pieces of advice that maybe a lot of people don't even talk about, that a successful trader or people like us who've been in the market for a long time can pass on to newer traders. Spend more time identifying strong trending markets and then identify trades in that same direction. You'll sleep better at night. Tighten up your money management approach. Here's the second one. I don't know if, for some of you who know the name Paul Tudor Jones, which was one of the most successful futures traders in the business. and I do believe he's getting close to retirement now, or may have just retired. But he did a video back in the 80s, and it showed him trading, during his heyday when he was still trying to make a name for himself. And obviously, he quickly got to the point where he didn't want to be in the public eye because he had all the clients that he wanted, and he just wanted to be kind of private and live a normal life. But there was a time when he was doing some promotional videos, and he was trading at one time, and he turned around and he looked at the camera and he says, you know, I don't understand people who don't trade with the trend. If they just traded with the trend, you'd be surprised how much easier being profitable is. And then he turned right back around and turned to the screen. Well, I got to tell you, it hit me in the head like you wouldn't believe, like I'd just been hit with a tsunami or something. And I'm saying, if this guy who, we're sitting there, giving the I'm not worthy chant to, is telling me that he's a trend trader, and if everybody were trend traders, they'd be, they could experience the same kind of success. Of course I listened to him, and that really changed my trading. So, not that I'm going to have that same effect on you, but trust me, trade in the direction of the trend, tighten up your money management approach. Those are the two keys to trading. Everything else can be negotiable, but if you've got these two working for you, you are really close to being on your way. And by the way, what Dan had asked before, if you start with a $2,000 account and 6 months later you're still at $2,000 and you've been trading, give yourself a pat on the back. You're on the way, because you've got to learn to walk before you can run. And if you're at break even after 6 months, you're doing a pretty darn good job if you're fairly new to the game. Be detached about the outcome of any one trade. After a win, don't walk around thinking, now, do people recognize me as a genius? I don't know. They're not looking at me like I'm a genius, okay? Because the market, like I said, it will figure that out about you, and it will punish you for getting cocky, okay? Also, at the same time, you've had a losing trade, don't mope around saying that I'm not cut out for this. Maybe I'm not smart enough. Maybe my friends or family are right, that this is just a waste of time and a waste of money. It's not. But we want to trade like professionals. No reason to reinvent the wheel. Do what they're doing, and eventually your results will be similar. Remain consistent in your approach, and your results should be consistent. This is really key also. We're going to spend a lot of time trying to identify an approach to trading that makes sense to us, and kind of works. We've talked about a couple here with the breakouts and with the indicators, but it just may not be your cup of tea. But spend time identifying the strong trends and use money management to take advantage of them. Identify a way to get in and out of the market, and then really stick with it. Don't change it unless you've got some historical data to tell you that it's worthy of a change, that it needs to be changed. Stick with it. As Greg said yesterday, think of a coin toss. Got a 50-50 chance, and our goal should really be to win half of our trades and make more money when we're right than when we're wrong. That is a formula for being profitable. But just because you lose 3 coin tosses or 3 trades in a row, nothing wrong with the coin, nothing wrong with our approach. It's a numbers game, okay? That's when you're being tested. Pass the test. Remain consistent in your approach, because you've taken the time to look historically and found that what you're doing makes sense, what you're doing works, but it's just not going to work every darn time. That's just a fact. Never stop learning more about trading. And let me first of all congratulate you for those of you that are sitting here listening to me ramble on about trading and how to move up to the next level of trading. Thank you very much for not stopping to taking the time out of your day to learn more about trading. That is the only way to move up to the next level of trading. It is the shortcut. Education is the shortcut to anything, okay? Like I said, at Aura FX, it is our goal to make sure that all of our traders are profitable. As educators at Aura FX, it's our job to make sure that all of our traders are profitable. And I'm going to go out there on the limb and assume that that's your goal at the same time, to be profitable. So it's not like this is a, of course it is a win-win-win situation, but you're not necessarily our clients. This is a partnership. We're all in this together, and we're trying to get everybody to rise up to another level at the same time. And taking your time out to take advantage of these educational opportunities that we're offering really says a lot about your goals, and really says a lot about the fact that you're willing to stick to it and try to move to the next level of trading. Congratulations and thank you on that one. This is not going to be next. I think we're going to see Greg McLeod coming up, And but again, I want to remind you, we've got that $500 account raffle coming up at day 2. We had a winner yesterday, and but everybody can be a winner by doing some feedback and participating in the boot camp. Open up a live account, give you $50 to trade, and like I've mentioned quite a few times, the demo account is perfect for learning about the investment vehicles and learning how to use the software. But if you want to learn about trading, you've got to have real money on the line, because that's when the palms are going to start sweating, and that's when the market's going to test you. Even if it's only $1, you'd be surprised at the difference between a real dollar and a pretend dollar. Maybe you won't be surprised. Maybe maybe you've already experienced that at the same time. Other than that, I thank you very much for joining me. Greg McLeod is going to be up in about 15 minutes, and then I will be up again after that to talk about the multiple time frame analysis. We're going to spend some time talking about the trending markets again, and then how to zone in on a shorter time frame to really turn it up a notch and to take advantage of those strong trending markets. Thank you very much, and we'll see you down the road. And stick around, because Greg is going to be around here in about 13 minutes to talk about, those news announcements. And I'm sure we'll be talking a little bit about, to remind you again about what's coming on tomorrow morning.